welcome to the Deep Dive. Today, we are undertaking what I think is a really critical mission. We're going to demystify the dense regulatory blueprint that protects one of the most vital financial journeys anyone takes. We're talking about retirement planning in India. Our focus is squarely on the Pension Fund Regulatory and Development Authority, or as we'll call it, the PFRDA, and the architecture of the National Pension System, the NPS.
It's such an essential area to explore. I mean, unlike, say, equity trading or buying a short-term bond, pensions involve liabilities and assets that you're measuring in decades, not months or years.
Right. The time horizon is massive.
It is, and when any government sets up financial regulation, the foundation really rests on two pillars. The first pillar is all about creating the right framework for the orderly growth and development of these financial markets.
Making sure the system itself is healthy and can expand.
Exactly. But the second pillar is just as important, and it's the direct protection of the people using those markets. It's about protecting the interests of the investors.
That dual mandate is fascinating: growth on one side, protection on the other. Let's zoom in on that protection part, especially for retirement. I mean, why does a retirement investor need such a specialized body like the PFRDA? Why not just lump it in with, the main securities regulator?
That's a great question, and it gets to the heart of the issue. The typical retail investor, especially someone saving for retirement, is inherently the most vulnerable participant in the entire financial ecosystem.
The most vulnerable link in the chain.
Precisely. We can define them by, say, three main characteristics that create this disadvantage. First, they're typically dealing in small investments compared to the big institutional players. Second, they have limited skill and knowledge about really complex financial instruments. And third, and this is crucial, they have very restricted access to information compared to the professionals who do this all day.
So if you're investing over, say, a 30 or 40-year period, you just don't have the time or, frankly, the expertise to constantly monitor the asset managers or the record keepers.
You don't. And that's where PFRDA comes in. It steps in to be that highly informed, perpetual watchdog on your behalf.
Okay, so its regulations are built to counteract those disadvantages.
That's it, exactly. They're specifically designed to neutralize those three things we mentioned, to mandate transparency, to standardize the level of expertise, and to enforce stability over those, multi-decade horizons. Without that kind of rigorous oversight, the system would just collapse under its own complexity in that long time frame.
Understood. Now, the PFRDA isn't just floating out there alone in this massive economy. It's part of India's powerful financial governance structure. Let's just quickly place it within that landscape. Who are the other main players at the table?
Right. So we often refer to them as the big four regulators that oversee the country's financial flows. First, you have the Reserve Bank of India, RBI, which is the central bank, the monetary authority. Then there's the Securities and Exchange Board of India, SEBI, which governs all the capital and equity markets.
The market watchdog. The market watchdog, yes. Then we have the Insurance Regulatory and Development Authority of India, IRDAI, handling all insurance products. And finally, our main focus for today, the Pension Fund Regulatory and Development Authority, PFRDA.
And our deep dive is dedicated to mapping that last one. We're going to examine its legal power. We'll look at the precise financial requirements it sets for every single entity involved in the MPF.
From the fund managers to the trustees.
Right, all the way down the chain. And then we'll analyze the critical rules that govern your experience as a subscriber right up until the day you get your final pension payout. All right, to really grasp the PFRDA's authority, we need to trace its origins. When did this body go from being just a concept to a fully empowered statutory regulator?
That transition was formalized with the passage of the PFRDA Act 2013. Now, the new pension system itself had been functioning for a few years before that, but the 2013 Act is what gave the authority the legal muscle it needed.
The teeth, so to speak.
Yeah.
Exactly. The teeth to properly establish, develop, and most critically, regulate the entire pension system infrastructure. It transformed it from an interim body into a permanent, powerful regulator.
So establishing the rules is one thing, but what does that legislation define as the authority's core, non-negotiable responsibility? Is it just about checking boxes for compliance, or is it something more direct for the subscriber?
Oh, it's much more direct. The explicit core function is protecting the interests of subscribers, full stop.
And how is that mandate actually operationalized?
It's done in several ways. It means ensuring that funds are managed in strict adherence to the prescribed investment norms. It means monitoring that the operational costs charged to you, the subscriber, remain reasonable and justified. And very importantly, it means creating a transparent and robust mechanism for grievance redressal across all the intermediaries. It's a very proactive, protective role.
So who exactly is in charge of this massive proactive oversight? Let's look at the actual structure of the PFRDA itself. How is the authority put together?
The authority is structured as what's called a body corporate, so it's a continuous legal entity. It's made up of 7 individuals, and they're all appointed by the central government to ensure stability and, alignment with government policy.
And those 7 are?
You have a chairperson, then 3 whole-time members, and finally 3 part-time members.
Let's dig into that composition for a second. Why the distinction between whole-time and part-time members? What purpose does that serve in a regulatory body that's supposed to be focused on long-term stability?
That's a really insightful question. The whole-time members are there to provide the day-to-day regulatory continuity and deep sector knowledge. They're the ones completely dedicated to the operational and developmental side of the pension sector.
The engine room.
You could say that. The 3 part-time members, on the other hand, they often bring in external specialized expertise, maybe from economics or law or public administration. This allows the authority to tap into diverse, high-level policy insights without needing those experts to commit to the full-time grind of regulatory bureaucracy.
So it ensures a more balanced, well-rounded perspective when they're setting long-term policy.
Precisely. It leverages external intellectual capital.
That makes a lot of sense. Now let's talk about the sharp end of regulation enforcement. If an intermediary decides to ignore PFRDA's rules, or even worse, commits malpractice, what kind of serious powers does the PFRDA actually wield to step in and stop it?
This is where the PFRDA really shows its regulatory weight. Of course, they have the authority to ensure compliance of all intermediaries, and if they find violations, they can impose some very heavy penalties and mandate corrective measures.
Standard regulatory stuff.
Right. But here's where it gets really interesting and powerful. The PFRDA also possesses search and seizure powers to investigate severe contraventions of the Act.
Search and seizure. That sounds more like a police power, not just an administrative one. Help me understand the implication of that. How is that different from a standard audit?
It's completely different. A standard audit relies on the entity willingly providing documents. You ask, they give. Search and seizure is an immediate interventionist tool. If the PFRDA has reason to suspect that, say, a pension fund manager is actively manipulating records or diverting funds, a serious contravention of the Act, they can get a warrant and physically enter the premises.
Wow.
And they can seize records, hard drives, physical assets right then and there. This capability is absolutely vital because in cases of suspected fraud or asset diversion, just waiting for documentation to be produced allows evidence to be destroyed or moved. This power establishes that the PFRDA isn't just a policy setter, it's a formidable financial enforcer.
That level of enforcement capacity really is designed to protect the integrity of the whole system. It sends a clear signal to all the intermediaries that compliance is completely non-negotiable. Okay, to fully contextualize PFRDA, we do need to look at the other major regulators. Let's start with the big one, the central bank. How does the Reserve Bank of India's broad mandate affect the MPS subscriber?
The RBI is the monetary authority, so it really sets the tone for the entire economic environment in which pensions have to operate. Its primary function is to formulate, implement, and monitor monetary policy.
With what goal in mind?
It's aiming for 2 main objectives. First, to maintain price stability, which really just means controlling inflation. And second, to ensure there's an adequate flow of credit to productive sectors of the economy.
Okay, I see the connection. If the RBI fails to contain inflation, the real returns on your pension over 30 years could be, well, severely eroded, even if the nominal growth looks good on paper.
It could be wiped out. And if they don't manage the credit flow, it directly affects the growth of the underlying companies that the pension fund managers are investing your money in.
So PFRDA manages the structure of the funds.
But the RBI manages the value of the currency and the stability of the entire economy. They're completely intertwined.
Okay, next, let's look at SEBI, the market watchdog. The securities markets are, of course, where pension funds are primarily invested. What are some of SEBI's most powerful tools for maintaining market integrity that, indirectly protect our pension wealth?
SEBI has some very immediate, almost surgical tools to address market fraud. For instance, when SEBI is investigating fraudulent or manipulative activities, they have the power to suspend trading of any security instantly.
To stop the bleeding.
Exactly, to prevent further damage. They can also restrain persons from accessing the securities market entirely, which is basically the financial equivalent of freezing their license to operate. And critically, they have the power to impound and retain the proceeds or securities that are under investigation.
Impounding assets. That's a swift measure to claw back any ill-gotten gains before they disappear into the ether. That sounds very similar to the PFRDA's search and seizure power we just discussed.
It is very similar. It's applied to financial transactions rather than physical premises, but the intent is the same: immediate intervention. And beyond that, SEBI focuses intensely on fairness. We have to talk about their regulations against insider trading.
Which is absolutely essential for public faith in the market. Without that, the whole thing falls apart.
It does. The SEBI Prohibition of Insider Trading Regulations 2015 are incredibly comprehensive. They target any individuals who are connected with a company who might deal in securities while they possess material, unpublished, price-sensitive information. This ensures that the PFMs, who are operating on behalf of millions of subscribers like you, are investing in a market that is fundamentally fair. A market where one party isn't cheating based on privileged information.
It's that constant fight against information asymmetry. Now, stepping back from the regulators for a moment and looking at the government itself. Which specific government departments are administering the policy and the tax structure that surrounds pensions?
This involves two crucial departments, both within the Ministry of Finance. Firstly, you have the Department of Revenue. As the name suggests, this department controls all matters relating to direct and indirect taxes.
So they're the architects of the tax regime, the ones who create the incentives and benefits tied to NPS contributions, like the deduction sections.
Correct. The second department is the one responsible for the strategic direction and the ongoing evolution of the pension system itself. That is the Department of Financial Services.
Fair.
This department holds the policy keys. They administer government policies related to pension reforms. They work very closely with the PFRDA to make sure the regulatory environment is adapting to, say, demographic changes or new macroeconomic realities.
So, to put it simply, PFRDA sets the operating rules on the ground, but the Department of Financial Services sets the overarching policy mandate from the top.
That's a perfect summary.
That sets the foundation beautifully. Now let's start to construct the actual ecosystem. If the PFRDA is the regulator, who is the ultimate steward of the funds, who physically holds the money on behalf of the subscriber.
That role belongs to the National Pension System Trust. This is the fiduciary heart of the entire system.
The fiduciary heart, I like that.
And their core responsibility is monumental. They are tasked with holding and managing the assets and funds that are created out of all subscriber contributions. And they have to do this solely in the subscriber's beneficial interest. They are the ultimate custodian.
And a fiduciary, just to be clear, is bound by law to act in the best interest of the beneficiary, in this case, the subscriber. So, given this massive responsibility, managing the nation's entire pension pool, the requirements to even become a trustee must be incredibly high.
Well, they are. The PFRDA's criteria for their appointments are extremely strict.
What are we talking about here?
The requirements are all based on character, capability, and a clean history. First, the individual must be a citizen of India. Second, they have to demonstrate outstanding ability, integrity, and standing. So, proving competence and a spotless ethical track record. But maybe the most stringent check is the negative requirement. The candidate must not have been convicted of any economic offense or violation of securities laws.
That is a critical filter. The integrity test is designed to be absolute, right at the foundational level. It ensures that the people holding the deed to the country's retirement wealth are, well, beyond any reasonable financial or legal reproach.
It has to be absolute. Any compromise on integrity at the trust level could undermine confidence in the entire long-term system.
Okay, let's move from the safekeepers to the entities that actually put the money to work. The pension fund managers, or PFMs, these are the asset managers. What's the financial threshold that PFRDA sets for a company just to be eligible to apply to manage these funds?
The financial bar for entry is pretty high, and it reflects the long-term commitment that's required. To be a PFM, the entity must be incorporated as a limited company, and it has to maintain a very robust financial cushion. We're talking a minimum positive tangible net worth of ours is 25 crores.
25 crores. That's a significant number. Let's delve into the rationale a bit. Why that specific figure? Is it just a way to show they're stable, or is there a deeper regulatory purpose?
It serves several purposes, actually. Firstly, that level of capitalization acts as a buffer against any operational losses. It ensures the PFM can continue functioning through market turbulence without risking the subscriber's capital. Secondly, it ensures that only serious, well-established financial institutions enter the sector. It maintains the dignity and stability of the pension system.
So it weeds out the smaller, potentially less stable players.
It does. And compared to, say, the mutual fund requirements set by SEBI, this ensures a very deep commitment from the parent entity.
Okay, so once a PFM is approved, they start investing. We're talking about long-term diversification. Are there any mandates about geographic diversification? Specifically, can they get international exposure within the NPS?
PFRDA is extremely clear on this point, and it's a big contrast with many private retirement schemes you see globally. The rule is absolute. No pension fund shall directly or indirectly invest outside India the assets belonging to the subscribers.
Wow, that's a very firm boundary. What's the regulatory philosophy behind keeping the entire investment universe strictly domestic?
It's all about minimizing risk. Specifically, two layers of risk that are common in global funds. First is foreign exchange risk, and second is dealing with different or even conflicting international regulatory framework.
Which can get very messy.
Very. By keeping all the investments within Indian markets, PFRDA maintains full jurisdictional control. It ensures that your final payout as a subscriber isn't unexpectedly eroded by adverse currency movements right when you need the money back in rupees. It maximizes regulatory certainty.
It makes the regulator's job of oversight much cleaner, I'd imagine. Transparency is also vital. How frequently do the PFMs have to disclose their specific investment holdings to the public?
The required frequency is very high, and that's to maintain both subscriber confidence and regulatory oversight. The PFM has to publicly disclose information, including the script-wise details of each scheme, on a monthly basis.
Monthly. And is there a deadline?
A tight one. They have to do this rapidly within just 10 days from the end of the month.
Monthly, and within 10 days, that's practically real time in the investment world. That level of mandated disclosure is highly demanding. It prevents any hiding of positions or, window dressing at the end of a quarter.
It does, and when they report their portfolio, especially the debt portion, they can't just list the bonds they hold. They have to categorize the risks involved. PFRDA requires a comprehensive disclosure based on 3 key parameters for any debt securities.
Okay, let's define those 3 parameters because they are crucial for anyone trying to understand their fixed income investments.
The first is credit risk. That's simply the risk that the issuer of the bond defaults and fails to make their coupon or principal payments.
The company goes bust.
Essentially.
Mm-hmm.
Then there is interest rate risk. This is the risk that your bond's price falls because general market interest rates have risen. Your older, lower rate bond is now less attractive. And finally, there's liquidity risk. This is the risk that you can't sell the bond quickly enough in the market without suffering a significant loss on the price.
Thank you for clarifying that. Understanding those 3 really helps a subscriber or their advisor benchmark the safety of the debt portion of their portfolio. Now let's pivot to the entity that manages all the data. The system's operational spine, the Central Record-Keeping Agency, or CRA.
The CRA is the crucial IT backbone of the whole system. It's responsible for building, maintaining, and operating the NPS infrastructure itself. Think of it as the ultimate database and transaction processor.
Oh.
It acts as the operational interface for all intermediaries. The PFMs, the points of presence, everyone's data flows through the CRA.
And the financial requirement for the CRA is, as I recall, significantly higher than for the PFMs. We're jumping from 25 crore to a minimum net worth of rupees 100 crore. What justifies quadrupling that capitalization requirement?
It comes down to one thing: systemic risk. The CRA isn't just managing money, it's managing the records and the integrity of the entire system. If the CRA fails, if there's a major data breach or system collapse, the entire NPS system just grinds to a halt. It would cause massive disruption, potential data loss, and regulatory chaos.
So that 100 crore is a guarantee of stability.
It's a guarantee of extreme stability. It ensures they can make the necessary investment in things like redundant IT systems and have a massive buffer for business continuity planning. It's the cost of securing the data itself.
It makes sense. This agency is also responsible for issuing the subscriber's essential identity document within the NPS, which is the PRN.
That's right. PRN stands for Permanent Retirement Account Number. It is the unique identification number that's allotted to each subscriber, and it serves as their lifelong account key. It ensures portability and continuous tracking of their pension wealth, regardless of whether they change jobs or locations.
Now, in terms of conduct, the CRA is more of a utility, not a sales entity, but they do still charge fees.
Hmm.
How is their fee structure determined, and what's the regulatory stance on their behavior?
Their service charges aren't set unilaterally. The CRA will collect service charges based on the manner that is approved by PFRDA, so the regulator has to sign off and ensure the fees are fair and reasonable.
And their conduct.
They are explicitly prohibited from indulging in any unfair conduct. This includes any misleading or abusive practices that could interfere with your ability as a subscriber to make an informed transactional decision. Even though their primary role is operational, not advisory, they still have a duty of fair conduct.
That prohibition protects the subscriber from any subtle manipulation, even in the administrative process. Okay, next up, let's talk about the boots on the ground, the point of presence, or POP. These are the frontline entities, often banks, where the subscriber physically interacts with the NPS.
Yes, the POPs are the collection and onboarding interface. Their minimum financial threshold is lower, which is appropriate for their more localized service role. They have to have a net worth of rupees 2 crore, and that has to include a minimum paid-up equity capital of rupees 50 lakh.
When a subscriber gives a contribution check to a POP, how does PFRDA ensure that money is immediately insulated from the POP's other business activities, to maintain the safety of the pension fund?
This is a critical ring-fencing rule. The account that's used by the POP to collect subscriber contributions must be established as a non-withdrawable account. The funds in that account are legally required to be transferred only to the account of the National Pension System Trust.
Ah, so there's no way for the POP to dip into that cash.
None whatsoever. This ensures that your contributions are treated as fiduciary funds from the exact moment they are deposited, and they're completely protected from the POP's commercial balance sheet.
So the POP is merely a transparent conduit. They can never use that pension money for their own operating capital. And on the operational side, I assume they have to be meticulous with the paper trails.
Absolutely. The POPs must maintain a complete and accurate record and transfer the original application forms, along with all the necessary stipulated documents and KYC records, to the CRA. This ensures the CRA has the verified foundational data for the subscriber's PRN.
We've covered the entire chain now, except for the final product provider, the annuity service provider, or ASP. These are the entities that take the final lump sum and guarantee a lifetime income stream.
Considering they're carrying the risk of life expectancy, potentially paying someone for 40 or 50 years, what is their required financial net worth?
Their capitalization requirement is the highest of all. To be eligible as an ASP, which is typically a life insurance company, they must have a minimum net worth of Rs, 250 crores. 250 crores. That's 10 times the requirement for a PFM and 2.5 times the requirement for the CRA. Let's just pause and analyze that scale. Why does the annuity provider need such a vastly larger financial buffer?
Because the liability they're taking on is fundamentally different. A PFM manages assets. They just need to weather market cycles. An ASP, on the other hand, assumes longevity risk.
The risk that people live longer than expected.
Longer than actuarially predicted, yes. And this is a non-market, potentially infinite liability. If an ASP collapses, hundreds of thousands of retirees could suddenly lose their monthly guaranteed income. It would be a social and financial disaster. That 250 crore figure is not just about stability, it's an assurance of solvency that has to stretch across the entire demographic lifetime of all their annuitants.
It is the ultimate guarantee of long-term income, and the capitalization absolutely reflects the seriousness of that promise.
Yep.
We've established the structural security that's provided by this highly capitalized ecosystem. Now let's pivot to the more personalized experience, the retirement advisor, the RA. This is where the human element really enters the picture, and where PFRDA needs robust rules to prevent any misguidance.
Right, and the rules for RAs are all codified in the PFRDA Retirement Advisor Regulations 2016. This specific regulation was crucial because it formalized a field that was, previously unregulated. It sets the entire framework for eligibility, the registration process, fees, and it precisely defines the RA's scope of work and responsibility. The goal was to build professionalism and trust.
So what are the PFRDA's minimum standards to ensure competence? You can't just be a motivated amateur, I assume. You need to have established credentials.
That's correct. The regulator demands a combination of both education and experience. To be registered as an individual RA, the person must be a graduate in any discipline or possess a professional qualification in a relevant financial field.
And what about experience?
Crucially, they must also have post-qualification experience of at least 3 years in activities directly related to financial advice.
That 3-year experience threshold seems important. It ensures they have practical, real-world knowledge, not just academic understanding from a textbook. Once they achieve that registration, how long is it valid for?
The certificate of registration is valid for 3 years. This requires RAs to go through a regular renewal process, which usually includes things like continuing education requirements and verification of their ongoing regulatory compliance. It ensures their competence doesn't stagnate over time.
Now, let's talk about the biggest challenge in financial advice: conflict of interest. Who is permitted to pay the retirement advisor for the advice they give?
This is the single most important integrity rule in the entire advisory structure. RAs may charge advisory fees only from the prospect or subscriber being advised.
Only from the client.
Only from the client. Their advice must be driven solely by the client's need, not by any product commissions.
So that's a clear-cut, fee-only model for advice. So if an RA recommends a specific pension fund manager scheme, that PFM is legally prohibited from sending any form of referral fee or kickback to the advisor.
Absolutely. That is the critical distinction. An RA shall not receive any consideration, no remuneration, no compensation, no bonus, nothing, from any person other than the prospect or subscriber for advice they provide on NPS or any other PFRDA schemes. This rule is designed to ensure the advice is unbiased and solely in the client's best financial interests.
It effectively eliminates that commission structure that plagues so many other parts of the financial services industry. It forces objectivity.
It creates a clean system of accountability, as you said. And on a practical level, safety and auditability are also paramount. There's a very simple rule regarding the handling of money itself.
Which is?
RAs shall not collect any amount in cash for investment or contribution to the pension account. Everything has to flow through formal banking channels linking back to the POPs in the CRA.
Which eliminates the risk of theft or money laundering, and it creates an ironclad audit trail for every single rupee that's invested.
Exactly. When we combine these rules, the fee-only compensation and the clean audit trail, they really define the essence of the RA's ethical obligation, which PFRDA defines as integrity.
And how does PFRDA articulate what integrity means in this specific context?
Integrity requires that the advice and the services provided to the client must always be in the best interest of the client. And crucially, the regulations add this phrase: this must be true, irrespective of the advisor's personal gain or detriment. The client's financial outcome is the RA's only mandated priority.
Integrity is the standard. Now let's look at the structure again. What if an RA is part of a larger financial institution that also offers execution services, maybe through its own POP? How does PFRDA regulate this potential structural conflict of interest?
This is handled by what's called the segregation rule, which mandates that the relationship must be maintained at arm's length. If an RA is also engaged in execution or distribution services, meaning they could profit from the client choosing their particular channel, they must ensure that their advisory services are clearly segregated from all of its other activities.
So the RA could say you need Plan X, but they must present Plan X even if another institution provides it more cheaply. And they have to be able to demonstrate that the advisory decision wasn't influenced by the profitability of their own distribution wing.
Precisely. That structural separation is required to prove that the advice stands alone, completely free of any channel bias. Now, turning to the actual advice that's given during that critical first step, risk profiling, what must the RA specifically emphasize when they're discussing retirement with a client? They have to manage expectations around time and liquidity, which is unique to pension planning. The RA must emphasize that retirement plans involve long gestation periods. You are locking up your capital for decades. And that early liquidation or exit from the scheme is explicitly not beneficial. They need to instill a sense of patience and commitment given the illiquid nature of the product.
That's a crucial countermessage in a financial world that so often promotes quick gains and easy access to your money. Finally, what mandatory disclosures must the RA provide to the client before any money changes hands?
Full transparency is required, as you'd expect. RAs must disclose all material facts related to the key features of the product. Specifically, they have to provide the client with the performance track record of the various investment asset classes that are offered by the PFMs, and also the annuity schemes offered by the ASPs. You need to see the historical performance before you can trust any future potential.
We've built the regulatory house and we've vetted the advisors. Now we arrive at what is probably the most crucial section for you, the listener: the rules that directly affect you, particularly when you reach retirement or need to exit the system.
Right, and the foundational principle of the NPS is that it is designed to provide income, not just a lump sum of cash. This is enforced through what's called mandatory annuitization.
Let's look at the standard planned exit. A government subscriber reaches superannuation, typically age 60. What is the minimum portion of their accumulated wealth that they must use to purchase that guaranteed monthly income?
Upon a planned superannuation, at least 40% of the accumulated pension wealth must be mandatorily utilized for the purchase of an annuity. The remaining 60% can be withdrawn as a tax-free lump sum.
40% minimum.
Yeah.
Okay. But what if a government subscriber has an unplanned exit? Let's say they resign or leave service prematurely before age 60. Does the PFRDA tighten that requirement?
Yes, it tightens it significantly. If a government subscriber exits prematurely, the regulatory requirement becomes much stricter, and that's to preserve a greater portion for their future income security. In that case, at least 80% must be utilized for the purchase of an annuity.
Wow, that's double the minimum requirement. What is the regulatory intent behind that huge differential?
It really acts as a disincentive for premature withdrawal, and it ensures that even if an individual leaves the system early, they retain a substantial, guaranteed income stream later in life. If they exit early, they probably don't have alternative retirement vehicles that are mature enough to replace that corpus, so the system steps in to force them to protect their future self.
That's a very strong nudge toward preserving the pension characteristic of the fund. Now, is there any exception to this mandatory annuitization rule, even when you reach superannuation? Can a subscriber ever just withdraw 100% of the funds?
Yes, there is an exception, but only for smaller accounts. If the accumulated pension wealth upon exit is equal to or less than a sum of 5 lakh rupees, the subscriber is exempt. They can withdraw the entire amount as a lump sum without being required to purchase an annuity.
Okay, so that avoids forcing someone with a relatively small corpus to convert it into what would be a minuscule monthly pension. It gives them full flexibility with that smaller amount of capital. We also need to talk about late entrants, as PFRDA has recently accommodated them.
Yes, for subscribers who are joining the NPS under the All Citizens or corporate model after age 65, but before age 70, they still need to demonstrate a minimum commitment period. Such a subscriber can exit after completion of just 3 years from the date of joining.
That minimum 3-year lock-in provides some time for capital appreciation before they can access the funds. Before we move on to the permanence of the annuity, let's quickly revisit the tax angle we touched on earlier. What is the key deduction incentive for NPS contributions?
For those who are utilizing the old tax regime, the government provides a very important incentive. It's an additional deduction for an individual's own NPS contribution of up to Rs. 50,000 under Section 80 CCD 1B.
And that's over and above the standard ADC limit.
Exactly. It's a powerful above-the-limit deduction that makes the NPS highly attractive for high-income earners who are looking for maximum tax relief.
Okay, so the subscriber has now calculated their mandatory annuitization amount and chosen an ASP. The money is transferred. Let's talk about the finality of this decision. If they realize 6 months later that they chose the wrong annuity scheme, can they go back and redeem the principal?
This is the one rule that every single subscriber must internalize. The annuity purchase is, for all intents and purposes, permanent. The principal invested can neither be redeemed nor can a change be made in the type of annuity chosen.
So it's irreversible.
It's irreversible unless the specific contract terms with the ASP explicitly allow for some limited flexibility, which is very rare.
So you are swapping a lump sum for a guaranteed cash flow for life. This elevates the importance of the initial choice of the annuity service provider and the specific product significantly.
It truly does. It makes the need for that retirement advisor's objective, segregated advice absolutely paramount. And when the ASP calculates the rate, the monthly payout, what personal factors heavily influence that figure? Annuity rates are purely actuarial calculations, and they're based on expected lifespan. The two primary personal factors are the age of the annuitant and their gender. Generally, older annuitants will receive a higher payout per rupee invested because their expected payout period is shorter.
Makes sense.
Conversely, women typically receive slightly lower payouts than men of the same age. And that's because, based on aggregate life expectancy data, women are expected to live longer, which spreads the total benefit over a longer period.
It's cold, hard statistics determining a lifelong income stream. Finally, let's address a simple but often overlooked personal life event.
Right?
Marriage. If a subscriber gets married, how does PFRDA manage their existing beneficiary nominations?
This is an automatic protective rule. A fresh nomination shall be made by the subscriber upon their marriage, and crucially, any nomination made before such marriage shall be deemed to be invalid.
So marriage automatically voids the old nomination.
Immediately. It's designed to prioritize the new spousal relationship, and it requires the subscriber to consciously reaffirm or change their beneficiary decision.
Despite all these rules, disputes and issues are, inevitable in such a vast system. If a subscriber has a grievance, maybe an incorrect valuation or a delay in processing, where do they go first, and how fast is the system legally required to respond?
The first port of call is the NPS trust, as the ultimate fiduciary. The trust is legally mandated to dispose of every grievance within a very strict time frame, 30 days from the date of receipt. That 1-month deadline is designed to force internal efficiency.
30 days for the system to correct itself. But if the subscriber finds that resolution unsatisfactory, or the 30-day deadline passes without a proper response, what is the next independent level of appeal?
At that point, they can prefer an appeal to the Ombudsman. This is an independent authority designed to look beyond the internal decisions of the NPS Trust and its intermediaries. It's the final check on fairness.
And what timeline does the Ombudsman operate under to provide a final binding decision?
The Ombudsman's process is also time-bound. They will issue an award not later than 90 days from the day on which the appeal was filed. This clear timeline is essential. You can't have disputes over retirement savings dragging on indefinitely. The resolution has to be swift and final.
Right. The 30-day rule for the trust and the 90-day rule for the Ombudsman provide a very firm, predictable schedule for resolution. We have dissected so many layers of protection that PFRDA imposes on India's pension future. From the Rs 250 crore capitalization that's required for the annuity provider, reflecting the weight of their indefinite liability.
All the way to the elimination of commission kickbacks for retirement advisors.
Exactly. The entire structure is really engineered to safeguard the wealth of the retail investor over the course of decades.
That's the key takeaway. These rules, the segregation rules, the high net worth requirements, that absolute ban on investing outside India, they aren't just bureaucratic red tape. They are structural guarantees. They enforce stability, they enforce integrity, and they ensure that the NPS is a system you can commit to for a lifetime without having to worry about institutional failure or predatory advice.
It's the ultimate lesson in regulatory foresight. It's about managing risk not just for today, but for 40 years from now.
Precisely. And while we focus so intensely on the domestic regulatory risk, knowing this framework should encourage you to consider the external risks that can still impact your retirement wealth.
What's the next logical step in planning for our listener, particularly for those who might have some international exposure?
Well, if you are an NRI who plans on eventually repatriating investment proceeds from India back to, say, the US or Europe, the regulatory compliance in India might be perfect, but you face the unavoidable risk of currency depreciation.
The FX risk.
Right. If the rupee weakens relative to the dollar or the euro between the time you invest and the time you repatriate, it will directly reduce the effective yield on your entire NPS corpus once it's converted. That currency risk is a massive consideration that is completely outside the PFRDA's mandate, but is critical to your final result.
That is a fundamental challenge for any kind of global financial planning. You have to factor in that volatile external layer of risk. Any final quick fact we should leave the listener with, maybe related to general long-term asset management in India?
Yes, often property ownership is a major part of retirement wealth. For anyone holding property in India, it's vital to understand the distinction between two key documents. The sale deed establishes your ownership on the title. It proves you bought it. But the equally important document is the Katha certificate. This certificate confirms that the property's construction plan was approved by the local municipal body.
And without that?
If you lack a clear Katha certificate, liquidating or transferring that property later in life can become severely complicated. Both documents are absolutely foundational to being able to efficiently access that retirement capital when you need it.
Financial knowledge is power. And knowing the rules of the house, whether it's the PFRDA's rules for pensions or the rules of your property ownership, is the best defense against long-term risk. Thank you for walking us through this incredibly detailed and secure system.
My pleasure. Stay informed and review those policy documents.
That was the deepest dive into the PFRDA's world you'll get today.